This is LXBN TV, and I'm Colin O'Keefe. Since its IPO, social networking giant Facebook has had much more to worry about than just a falling stock price, as securities suits and federal investigations are now coming their way. To explain the latest, we bring in James Saksa, attorney with Fox Rothschild and author on the Securities Compliance Sentinel. Jim, first off, what seems to be at the root of all this negative attention Facebook has been receiving following the IPO? Where did they slip up exactly?
I think really the start, that question isn't where they slipped up, but so much the focus on all the attention. It's Facebook, which is, arguably one of the most transformative pieces of technology, that's arrived through the internet. So because of that, there's already an outsized amount of attention on it. So that said, you have a lot of people that are really focused and interested in it. So what went wrong? This is also over a year coming. They delayed it once already. A lot of a lot of people really focused on it. So what went wrong? Well, on May 9th, Facebook revised its prospectus. The prospectus is essentially this document that companies use in the IPO to sell their securities. And this revision made a couple of small changes in the risk factors and other parts of it, where it said essentially that the amount of daily active users that Facebook has, they've been accessing Facebook more using their mobile applications, their mobile phones, their smartphones, than on the regular PC website. And the problem there for Facebook, as they acknowledge elsewhere in their prospectus, is that they don't have a lot of, I don't think they have any ads actually on their mobile apps right now. Mm-hmm. So they're not going to be able to generate the large amount of ad revenue that they are hoping to by people using the mobile apps. I believe the amount of revenues that Facebook gets from advertising is like over 80% of the revenue. So it's a large part of the business. So on May 9th that happened. Now that's public information. That gets filed to the FCC. Everyone gets to know about that. It seems that, and I guess is where the allegations lie to a certain extent. In response to that, a couple of the underwriters, analysts at the underwriters, started suggesting that the share price is going to be lower. That this wasn't as good a stock to buy. And as is common practice in this scenario, the underwriters shared that information with certain investors. They weren't hiding it. If you, as a retail investor, went and tried to ask your broker to get more information, and the broker went and asked Morgan Stanley, what's your research analyst saying now, they would have found out.
Yeah.
But it wasn't put out to everyone. So come the day of the IPO, you have NASDAQ had some sort of technical issue, delayed the trades in the morning, which didn't help the situation. Already people were nervous. And towards the, that really didn't help. And then towards the end of the day, and in the next couple of days, the stock price, which started out at 38 was the asking price, tumbled. And in most IPOs, investors sort of expect to see it pop after the IPO. So if you sell, let's say, at 38, they're sort of expecting it to go up in the immediate trading afterwards to maybe 40, 42 or something along those lines. This did not happen.
Yeah.
So when that didn't happen, people got upset, lawsuits started being filed.
Yeah, I think you mentioned this in your piece. When people unexpectedly lose money, that's when they tend to get a little upset and they can start filing lawsuits. So looking at those lawsuits, we've seen a couple security suits start to come in. Can you explain those for us? What claims have been levied against the people who are facing these security suits?
So from what I've read, and I don't think I've read all of them so far, there's essentially one basic allegation using essentially two different parts of um, the Securities Act. That said, more or less that the underwriters or Facebook or both lied. Um, one of the cases is solved. The New York case, um, uh, class action, is alleging violations of Section 11 and Section 12A2. And those are two sides of the same coin, essentially. Both of them say that you cannot you cannot make untrue statements of material facts or omit a fact like that, essentially. Um, Section 11 says you can't do it in the registration statement, which is the S1 statement that gets filed with the SEC the day of the IPO. 12A2 says you cannot do it in the build-up to the IPO in either the prospectus or any of the oral communications. The allegation essentially is that you know, that Facebook knew, or in the case of the underwriters knew that the expected revenues were going to be significantly less, and that these were not disclosed to investors during the roadshow. And and then with the Section 11 claim that the current S1 that is filed with the SEC is just incorrect. That it does not state the true nature of what's happening at Facebook. The problem with this, again, though, is that on May 9th, Facebook revised its prospectus. They said, we're getting more people than we thought switching from the PC to the mobile apps, and this is one of the major risks in our business, is that we haven't found a way to sufficiently monetize the mobile apps. They stay as a risk. It's on page 4 of the S1. For these claims to really succeed, it has to be something more. Like they seem to be relying on the implication that the analysts at, say, Morgan Stanley, knew something more that they weren't telling everyone. What's probably more likely is they saw the change and were able to surmise that things were going quicker than previously thought, and that the revenues are going to go down, and they changed their their projections based off of that.
Yeah.
So unless there's some sort of and this is what maybe we will find something out. There are also SEC and FINRA investigations being launched. Unless we find out some other facts, just from what is out there now, it doesn't seem like they have a tremendous case. That said, I'm not on the inside here.
Yeah.
I don't know. I can't make predictions.
And then finally, you touched on this a bit in your piece, and then also earlier. How much has hype, and then also the fact that Facebook's value lies in the relatively unknown worth of user data played into this? We have hype, and then of course we don't really have a value on user data right now. It seems like almost the value of that is getting lower by the day because advertising isn't working as well.
Yeah. Before Facebook's IPO, Warren Buffett stated publicly that he wasn't going to invest in it because, he said essentially the extraordinary companies out there are the hardest to value. I agree with that. And what I also agree with is something we really should keep in mind, I should have stated earlier, is that Facebook isn't weird in that it didn't have this pop. Granted, most companies have that pop. There are really two things here. First, this is a good thing for Facebook, that if they sold at 38, the people that sold, and I should also back up and say that the people that sold in the IPO, a lot of the shares were actually the early investors and the employees. They participated in the IPO. They got to sell out and make their money then. But the other part of that is there wasn't this pop, but there hasn't been a pop in any of the major recent, I guess, social media IPOs. Groupon, just looking at some numbers here, Groupon's down 55% since November in its IPO. Pandora's down 43%. Zynga's down 28%, and Yelp is down 20%. I think only LinkedIn is the only one that's actually up since its IPO. So you see with a lot of these, the sort of you know, the indicia of there being a lot of like hype about it, people being really excited at the forefront, and then getting a inflated price that inevitably goes down because of social media. Facebook, because it is the social media, was bigger than all of that and got more attention than all of that.
Yeah, I mean, I think it's really interesting. It's just I mean, everyone thinks it's cool to use, but when it comes down to making serious decisions about it on things like investing, it seems like everyone's like, I don't know what to make of this because you just don't know what their value is with properties like that. And I mean, LinkedIn's the only one that's gone up, and LinkedIn's also the only one that seems to have a better revenue model with its pro services and that type of thing as well.
And the risk factors in Facebook's perspective say, we haven't fully figured out how to monetize everything about this, and it's true. Like the risk factor essentially is that this is so new, people don't know about it yet, and in order to really understand how to price something, you need to understand it. It's basic microeconomic theory.
Yeah, it's going to be interesting to watch. They're not only getting hit from just monetizing what they have, but also facing government actions that are almost fighting it, trying to prevent user data from being shared in certain ways. So it's going to be interesting to watch going forward. Once again, that was James Saksa, attorney with Fox Rothschild and author on the firm's blog, the Securities Compliance Sentinel. To see more insight on the Facebook IPO, be sure to check out their publication. It's at securitiescompliancesentinel.foxrothschild.com, and we have a ton of insight as well at lxbn.lexblog.com. Thanks, Jim.
Thank you.